Hi everyone, welcome to week 7, our last week. We have an example of homework problem 2 to start off with. You should be fine with homework problem 1. But for 2 it says, for the year just completed, Bob had net income of $80,000, balances in the company's current asset and current liability accounts at beginning and end of year are as follows. You're given all that information. We have accumulated depreciation as a $40,000 credit during the year. And we're going to use the indirect method to determine the net cash provided by operating activities for the year. Well, the first thing we're starting off with is net income, which is given $80,000. That's how we started. But before we go through it, I just want to go over something really quickly. What happens is if you're looking from your beginning to your end of year. If you have a current asset account that increases, that's a use of cash. And let me give you an example of why that would be. Let's say you increased your inventory. You went out and bought that inventory. You bought it with cash. You used cash, right? So your cash, when your inventory increased, your cash decreased. So that's why it would be negative. If you have a decrease in a current asset, that's a source of cash or an increase in cash. So that would be positive. And again, that would be like you sold your inventory. You sold your inventory, so you received cash. Current liabilities work exactly the opposite way. If your current liabilities increase, that's a source of cash. That's a positive figure. If your current liabilities decrease, that's a use of cash. So that's a negative figure. And again, an example would be, could be anything. Say short-term notes payable. If you had a short-term notes payable and it increased, you received cash. Somebody gave you, you borrowed $10,000, for example. When you pay that off and your notes payable, your short-term notes payable decrease, you're going to have to pay them $10,000. So that's a use of cash. So let's go through our beginning to end of year figures so we can adjust our net income to a cash basis. So we're going to just add in whatever our depreciation was. The reason for that is depreciation is not an actual physical outflow of cash. Right, so whatever our accumulated depreciation is, we're going to go ahead and add that back in. That was $40,000. Decrease in accounts receivable. Decrease in asset account is a source of cash. It's a positive figure. Increase in inventory. When we increase our current asset account, it's a negative figure. So we have negative $50,000. And again, we're just looking at the difference between the beginning and end of year. So, for example, our accounts receivable were was 160, it decreased to 150. That's where the 10,000 came from. Our inventory was 300, now it's 350. That's where that 50,000 increase came from. Prepaid expenses were 11,000, now they're 10,000. So we have $1,000 decrease in the prepaid expenses. After that, we're going to look at our current liabilities. So our accounts payable were 360, now they're 340. They decrease, so that's a subtraction. We have accrued liabilities. They were 8, now they're 6. They decreased. Again, it's current liability decrease. It's a subtraction. Our last one is income taxes. It was 32, now it's 34, so it increased by 2,000. That's an addition. So if we add and subtract all these various numbers, we get 19,000. 80,000 minus 19,000 is 61,000. So that's how you would solve that problem.